Welcome, focused learners, to today's explainer. Listen, we are unlocking one of the absolute most precise and honestly fascinating concepts in smart money trading today. We're taking a deep dive into the ICT, or Inner Circle Trader, rejection block. Now, if you have ever felt like the market was specifically targeting your stop loss, like they're out to get you, you're not paranoid. You're probably just on the wrong side of an institutional liquidity hunt. So today, we are enthusiastically introducing the rejection block. It is quite literally your ultimate tool to decode and, more importantly, capitalize on these institutional market traps.
Okay, let's dive into our agenda for this masterclass. We'll be hitting 5 key areas. First up, the smart money footprint. Then, the anatomy of a rejection. Third, we'll compare bullish versus bearish setups. Fourth, we'll look at rejections, breakers, and orders. And finally, we'll wrap up with execution and risk management. Let's get right into it.
Section 1. The smart money footprint. Let's talk about institutional traps. To truly grasp this concept, you kind of need to start looking at your market charts as a bit of a crime scene. Seriously, it's a place where massive institutions purposefully hunt for retail stop losses to build their own huge positions. I mean, it's a question literally every trader is asked in pure frustration. Why do breakouts suddenly reverse? You know the feeling. You see price surge past a key resistance level, you jump in on the breakout, and bam, instantly the market snaps back in the exact opposite direction. I want to validate that frustration for you right now. That is not just random market noise. It's not bad luck. What you're experiencing is a deliberate, algorithmically driven institutional trap designed specifically to sweep resting liquidity.
See, when institutions push prices past a swing extreme, say an old high or an old low, they do it for a very specific reason, to trigger the cluster of stop losses sitting just beyond that level. They desperately need that retail liquidity to fill their own massive orders. And when they absorb all those orders and then rapidly reverse the price, well, they leave behind an undeniable clue. That long wick left behind on the candlestick, that right there is the physical footprint of their liquidity raid.
So that brings us to our formal definition. An ICT rejection block is the isolated wick of a candle that swept liquidity at a key structural extreme and then sharply reversed. The price closes back inside the previous range, and that wick now serves as a super high probability zone for future support or resistance. And here's the key takeaway. Unlike standard order blocks that focus on the thick body of the candle, we are strictly isolating the exact zone, just the wick, where intense counterparty pressure stepped in and took complete control.
Section 2, anatomy of a rejection. Let's move on and see how this builds with some strict geometric rules.
We absolutely have to separate true institutional footprints from just random, meaningless market wicks. We do this by applying strict geometric rules, because you can't just trade every long wick you spot on a chart. To filter out the market noise, a standard quantitative rule is that the wick must make up at least 40% of the entire candle's try-to-low range. Alternatively, you can look for a wick that measures at least 2 to 3 times the size of the candle's body. If the wick isn't clearly elongated, it just doesn't represent that aggressive rejection and absorption of orders we're hunting for.
Now, beyond just the sheer length of the wick, there are specific physical traits we need to look for. The body of the candle must close near the opposite half of the wick. This shows us a total rejection of those extreme prices. Classic patterns that fit this exact profile: think pin bars, gravestone dojis, or dragonfly dojis. Interestingly enough, the actual color of the sweeping candle, whether it closes green or red, it doesn't matter at all. Oh, and if you happen to have a cluster of multiple wicky candles right at a swing extreme, you can actually map a multi-candle block. You just draw your zone from the nearest body open or close, all the way down to the absolute lowest or highest wick tip of that entire cluster.
And this brilliantly illustrates how we validate this setup in live market conditions. We look for a highly standardized 3-candle sequence. First, you have the impulse candle. This is what drives price forcefully into a key liquidity level. Second is the rejection candle itself. This one penetrates the level, executes the liquidity sweep, and then gets absolutely hammered by counterparty pressure to form that long wick. Finally, we need the confirmation candle. This third candle absolutely must close in the opposite direction of the initial impulse. That is what confirms that institutional control has definitively shifted the market state. Section 3. Bullish versus bearish setups. Let's look at market swing extremes.
Let's explore exactly how this footprint looks at the absolute extremes of a market swing by contrasting our 2 main setups. A bullish rejection block forms at a major swing low. Price dips down, sweeps the sell stops resting below the low, and then snaps right back up. It leaves a long lower wick with the body closing near the upper half. This move effectively traps sellers. Conversely, a bearish rejection block forms at a swing high. Here, the price spikes up to sweep buy stops, then drops rapidly, leaving a long upper wick with the body closing near the lower half. This completely traps breakout buyers. In both of these scenarios, that isolated wick acts as a highly precise entry point when the price eventually retraces back into it.
Section 4. Rejections, Breakers, and Orders. Let's compare the block trio.
Now, what's really interesting about this is that there's a lot of confusion out there regarding the major smart money array types, so let's clear that up right now. When comparing these concepts, an order block focuses entirely on the candle body. It's typically an area of institutional accumulation used for trend continuation. A breaker block, on the other hand, is basically a failed order block. It's an area where price broke right through, and now what used to be support acts as resistance, or vice versa. But the rejection block, it is entirely unique. It leverages only the extreme elongated wicks, totally ignoring the body. It signifies an aggressive liquidity sweep and an immediate, sharp reversal.
Section 5. Execution and Risk Management. Time to build our actionable playbook.
So understanding the theory is great and all, but trading is ultimately about execution. When it comes to your entry protocols, you generally have two main choices. The limit order approach involves placing a pending order right at the block's proximal boundary, which is just the candle body open or close, or at the 50% midpoint of the wick, which we call consequent encroachment, or CE. This gets you a beautifully deep discount, but it carries more risk if the momentum is still strong. Alternatively, the confirmation approach means waiting for the price to actually tap the wick zone, then zooming into a lower time frame to watch for a market structure shift before entering. This heavily reduces your risk. Either way, you must always ensure your trade aligns with the higher time frame daily bias. And try to only execute these during high volatility sessions like the London or New York opens, because that is where the real institutional volume is present.
So the absolutely crucial point here is how you protect your hard-earned capital. Your stop-loss placement must be incredibly strict. You want to place it 10 to 20 pips beyond the absolute extreme of that rejection wick. Listen, one of the biggest traps traders fall into is placing their stops way too tight, right inside the wick itself, because price often comes back to rebalance or tap that zone one last time. Hiding your stop inside the wick will routinely get you tagged out right before the market moves exactly in your intended direction. Give it that 10 to 20 pip buffer for sure.
Let's quickly run through the most common mistakes so you can avoid them entirely. First, do not trade random wicks in the middle of a range. If it hasn't swept a major swing extreme, it is simply not a true rejection block. Second, as we literally just mentioned, never place your stop losses too tight inside the wick. Third, do not trade against the dominant daily bias. Rejection blocks work so much better when they are aligned with the broader trend. And finally, avoid forcing these setups during low-volume market windows, like the late Asian session, where price action is often just meaningless, choppy drift.
Which brings us to the end of our explainer. I really want to leave you with this provocative question as you head back to your charts today. Are you reading the market's true footprint, or are you just reacting to its traps? By isolating these extreme wicks, applying those strict 40% geometric rules we talked about, and patiently waiting for proper confirmation, you can absolutely stop being the liquidity and start trading alongside the institutions that create it. Thanks for focusing in with us today, and happy charting.